Hi everyone, in this video we'll be going over A-Level Accounting 2023 Specimen Paper 4 question number 2. So this is a new paper because previously we only used to have paper 1, paper 2 and paper 3, and in paper 3 we used to have 6 questions, each of 25 marks, 4 of them related to financial accounting while 2 of them related to cost and management accounting. And this new paper 4 consists of those 2 questions which related to cost and management accounting, which means that this paper has 2 questions, each of 25 marks, and we're also given a time limit of 1 hour. So ideally, we should be spending about 30 minutes in order to complete each question. And in this video as well, we will be attempting to solve this question under 30 minutes. Now, without any further delay, let's get started. Z Limited receives an order from an existing customer to manufacture a new product for a period of 4 years. To satisfy this order, the directors of Z Limited have to purchase a machine from overseas with an expected cost of 300,000. The machine has a useful life of 4 years with no residual value. Then the directors of Z Limited have to hire a specialized engineer as well as purchase direct materials from a new supplier. And we're given the estimates relating to the operation of this order. We're given the cash inflow and cash outflow of 4 years. Then we're also given the cost of capital to be 10%. This is the interest rate that we will apply in order to discount in order to get our net present value. And the relevant discount factors are given to be of 10% and 12%. Let's have a look at our first question. We need to calculate the payback period in years and days. So payback period is basically the period when we get our initial investment back. And in order to see this, we need to figure out our net cash flow, right? So let's do that first. We have 4 years, so that's 1, 2, 3, and 4. Then we are given the cash inflow for all 4 years, as well as cash outflow. Let's write it down. So for cash inflows, we can see that for year 1, it's 200,000. For year 2, it's 230,000. For year 3, it's 240,000. And for year 4, that's 210,000. Let's write it down. That's 200,000 for year 1, 230,000 for year 2, 240,000 for year 3, and 210,000 for year 4. Now let's have a look at our cash outflows. For year 1, that's 140,000. For year 2, it's 130,000. For year 3, it's 110,000. And for year 4, that's 100,000. Let's write these amounts down. For year 1, that's 140,000. For year 2, that's 130,000. For year 3, that's 110,000. And for year 4, it's 100,000. Now we need to figure out our net cash flow. And net cash flow is just the difference between our cash inflow and cash outflow. So that's going to be cash inflow minus cash outflow. For year 1, that will be 200,000 minus 140,000, which results in 60,000. For year 2, that will be 230,000 minus 130,000, which results in 100,000. For year 3, that's 240,000 minus 110,000, which results in 130,000. And for year 4, that's 210,000 minus 100,000, which results in 110,000. Now let's figure out the total net cash flow for all 4 years. That will be the sum of these 4 amounts. That's 60,000 plus 100,000 plus 130,000 plus 110,000, which results in 400,000. And we were given information regarding our initial cost, which is of 300,000. But we can see that our total net cash flow is 400,000, which means that we get our initial cost back within these 4 years. So now we need to figure out the exact period in years and days. All right, let's have a look. From first year, we get 60,000. From the first 2 years, we get 60,000 plus 100,000, which is 160,000. That is less than 300,000. So our payback period is higher than 2 years. Let's have a look at the 3 years. We get 60,000 plus 100,000 plus 130,000, which results in 290,000, which is again lower than 300,000. So our payback period is greater than 3 years. But for 4 years, that's 400,000, but we only require 300,000, right? Which means that our payback period is going to be 3 years and some days. Now, in order to figure out the days, we know that from these 3 years, we get our 290,000 back, but we require the total of 300,000 back, right? So let's figure out the difference. That is just going to be 300,000 minus 290,000, And this difference is now to be fulfilled by our net cash flow from the fourth year, right? So that's 110,000. And since we need to figure out the payback period in days, we can just multiply it by the total number of days in a year, which is 365. And this way we get our payback period. So that is just going to be 3 years. And for days, that will be 300,000 minus 290,000 divided by 110,000 times 365, which results in 33.18 days. And we cannot keep the days in the decimal figure, so we need to round it off. That is just going to be 3 years and 34 days. This is the required payback period. Now let's move towards the next part. We need to figure out the accounting rate of return to 2 decimal places. And the formula for accounting rate of return is just the average profit divided by our average investment times 100%. Now let's figure out the average profit. So profit is just all of our inflows or incomes minus our outflows or expenses, right? And we already figured out that all of our inflows totals 400,000 and our initial expense is 300,000, right? So in order to figure out the total profit, we just need to subtract our outflow of 300,000 from our total inflows of 400,000. But remember, we're not talking about the total profit. We're talking about the average profit, which means that we need to divide this profit equally among the 4 years. So we're just going to divide it by 4, which gives our average profit to be 400,000 minus 300,000 by 4, which results in 25,000. Now let's figure out the average investment. And average investment is just going to be the initial outflow divided by 2. And in this case, that's 300,000 divided by 2, which results in our average investment to have the value of 150,000. Now we just substitute these two values and figure out the accounting rate of return. The average profit is 25,000. The average investment is 150,000 times 100%. And this results in our accounting rate of return to have the value of 25,000 divided by 150,000 times 100%, which results in 16.67%. And this is greater than the cost of capital, which was of 10%. So the accounting rate of return suggests that we should be investing in this project. Let's move to the next part. We need to figure out the net present value. And in order to figure out the net present value, we just need to multiply our net cash flows by our discount factor at the cost of capital, which is of 10%. So let's write it down. We start with our years. So that's 0, 1, 2, 3, and 4. Then we need our net cash flows. And in year 0, we have a net cash outflow or investment of 300,000, right? So that's just 300,000. And since this is an outflow, we just represent it by a bracket indicating that this is a negative amount. Now for the remaining 4 years, we already figured out our net cash flows right here. So we're just going to copy these amounts. That's 60,000, 100,000, 130,000, and 110,000. Let's write it down. So that's 60,000, 100,000, 130,000, and 110,000. Okay, now we just need to multiply it with our discount factor at the rate of our cost of capital, which is 10%. And the discount factor for time 0 or year 0 is always going to be 1, no matter what percentage we're looking at. Now let's copy the discount factors for year 1, 2, 3, and 4 from above, which is right here. So that's 0.909, 0.826, 0.751, and 0.683. Let's write these numbers down. That's 0.909, 0.826, 0.751, and 0.683. Now, in order to figure out the net present value, we just multiply our net cash flow and the discounting factor. So for year 0, that will be negative 300,000 times 1, which results in negative 300,000. For year 1, that's 60,000 times 0.909, which results in 54,540. For year 2, that's 100,000 times 0.826, which results in 82,600. For year 3, that's 130,000 times 0.751, which results in 97,630. And for year 4, that's 110,000 times 0.683, which results in 75,130. Now we need to figure out the total net present value, which is just the sum of the present values for these 5 years. So that will be negative 300,000 plus 54,540 plus 82,600 plus 97,630 plus 75,130, which results in the positive net present value of 9,900. So this is the required answer. Now let's move towards the next part. We need to figure out the internal rate of return to 2 decimal places. And the formula for internal rate of return is our low discounting rate plus the difference between the discounting rate. So that's higher discounting rate minus lower discounting rate. Then we divide it by the difference between the net present values for these rates. So that will be net present value at low discounting rate minus the net present value at high discounting rate. And then we multiply it by our net present value at the low discounting rate. So this is the formula. Okay, let's have a look above. We can see that we were given the discount factors for 2 percentages, 10% and 12%. So in this case, we can see that 10 is our lower discounting rate, whereas 12 will be the high discounting rate. So let's substitute these values. Okay, so the low discounting rate is 10%, the high discounting rate is 12%, minus 10%, and the NPV at low discounting rate is just going to be the net present value at 10%, which we just figured out to be 9,900. But we do not have the net present value at higher discounting rate. So that is something we need to figure out. And again, the net present value at low discount rate is 9,900. Okay, so the next step would be to figure out our net present value at the discount rate of 12%. So let's prepare a table for that. We have your 0, 1, 2, 3, and 4. Again, we need our net cash flows. And we can just copy this amount from right here. That's negative 300,000, 60,000, 100,000, 130,000, and 110,000. Let's write it down. That's negative 300,000, 60,000, 100,000, 130,000, and 110,000. Then the next step would be to write down our discount factor at the higher rate of 12%. Again, like I said before, the discounting factor for year 0 is going to be 1 regardless of the percentage. And for the remaining years, let's have a look above. We can see that the values are 0.893, 0.797, 0.712, and 0.636. Let's write it down. That's 0.893, 0.797, 0.712, and 0.636. Now the next step would be to figure out the net present values by multiplying our net cash flow and the discounting factor. For year 0, that's negative 300,000 times 1, which again is negative 300,000. For year 1, that's 60,000 times 0.893, which results in 53,580. For year 2, that's 100,000 times 0.797, which results in 79,700. For year 3, that's 130,000 times 0.712, which results in 92,560. For year 4, that's 110,000 times 0.636, which results in 69,960. Now we need to figure out the total net present value, and that will just be the sum of these 5 amounts. That's negative 300,000 plus 53,580 plus 79,700 plus 92,560 plus 69,960, which results in the negative value of 4,200. Okay, so we just need to substitute this value into our formula for the internal rate of return. That's minus, and we have a negative value again. So 2 negatives result in a positive, so that's plus 4,200. Now our internal rate of return is going to be 10 plus 12 minus 10 divided by 9,900 plus 4,200 times 9,900, which results in the internal rate of return to have the value of 11.40%. Alright, let's move towards the next part. Now we need to advise the directors whether Z Limited should purchase the machine to manufacture the new product, and we need to justify our answer with reference to financial and non-financial factors. Okay, let's have a look at the financial factors first. The first thing that we figured out was the payback period, which was 3 years and 34 days. And remember that the duration of our project is 4 years, which means that the payback period is before the end of the investment. So that is a good thing. Let's write it down. Payback period is before the end of investment. Okay, then the next thing that we figured out was our accounting rate of return, which was 16.67%. And as I mentioned before, this has a rate which is higher than our cost of capital of 10%, which is again a good thing. So let's write it down. Our accounting rate of return is higher than the cost of capital. Then we figured out the net present value, which has a positive value of 9,900. And a positive net present value is always good for any sort of investment. So let's write it down as well. The investment has a positive net present value. And lastly, we figured out our internal rate of return, which is 11.40%, which is again higher than our cost of capital of 10%. And that is also a good thing. So let's write it down. Internal rate of return is higher than the cost of capital. So if we were to make a decision based on the financial factors only, we would be advising the directors of Z Limited to purchase the machine in order to manufacture the new product, because each of these indicators favor in our investment. Okay, now we need to refer to our non-financial factors as well. So let's have a look above at the given information. Okay, we were told that we are buying this new machine in order to manufacture a new product. Right, and whenever there is a new product involving a new machine, it must mean that staff training will be required. So that is the first non-financial factor that we need to consider. So staff training will be required. Then again, let's have a look above. Okay, we were also told that the directors of Z Limited will have to hire a specialized engineer. So we also need to consider the availability of qualified specialized engineers. Let's write it down. Availability of qualified specialized engineer. Okay, and we were also told that we need to purchase direct materials from a new supplier, and whenever there is a new supplier involved, we have to consider the reliability. Let's write it down. That's reliability of raw material supply from new supplier. Alright, now based on these financial and non-financial factors, we now need to make a decision. So I would suggest the directors of Z Limited to purchase the machine in order to manufacture the new product. Let's write down our decision clearly. Z Limited should purchase the machine to manufacture the new product. Okay, now we can move towards the next part. We are given additional information. The expected cost of the machine, 300,000, includes an import duty of 20%. The import duty has increased to 30% due to a recent unfavorable trade agreement. Now we need to explain the impact of this increase in the import duty on the decision. In part B, we need to support our answer with calculations. Okay, so the very first thing that we figure out will be the new cost of the machine. So what we're told is this 300,000 also includes an import duty of 20%. So this just means that actual cost plus the 20% of the actual cost, which will act as our import duty, results in the value of 300,000. And from this equation, we can easily figure out the actual cost. So that is just going to be actual cost times 1 plus 20%, which you can write down as 0.20. And that will be equivalent to 300,000. Okay, from here we can easily figure out the actual cost. That is just going to be 300,000 divided by 1 plus 0.20, which is 1.20. And this results in the actual cost of the machine to have the value of 250,000. Okay, now the new cost is going to be the actual cost of 250,000 plus an import duty of 30%. So that is just 30% of the actual cost. And this results in the new cost to have the value of 250,000 plus 0.30 times 250,000, which results in 325,000. And previously our cost was of 300,000, but now due to this unfavorable trade agreement, our cost has increased to 325,000, which means that our cost has increased by 25,000. So let's write it down. The cost has increased by 25,000. Okay. Now the next thing that we can calculate will be the payback period. And for payback period, we're just looking at the time frame where we get our 325,000 back. And the cash flows does not change, right? So we can just refer to our previous cash flows, which is right here. So what we figured out was that from 3 years, we got 60,000 plus 100,000 plus 130,000, which is 290,000 of the investment back out of the total investment of 325,000, right? So the remaining amount will be funded by the cash flow from our fourth year, which is 110,000. Now we can easily figure out the payback period. That is just going to be 3 years plus our total investment of 325,000 minus the investment that we got from the 3 years, which is 290,000. And from the fourth year, we will be getting back 110,000. And since we need to figure out the payback period in days, I'm just going to multiply it with 365 days. And this gives our payback period to be 3 years. And the number of days will be 325,000 minus 290,000 divided by 110,000 times 365, which results in 116.15 days. And we need to round it off. So that is going to be 3 years and 117 days. Okay, let's have a look above. Previously, our payback period was 3 years and 34 days, but now it has increased. So let's figure out the increment. So the increment is just the difference. That's 3 years, 117 days, minus 3 years, 34 days. So the years get cancelled out. And the days is 117 minus 34, which results in 83 days. This just means that we require 83 more days to pay back. So we require 83 more days to pay back. Okay, then the next thing that we can calculate will be our accounting rate of return. And for this, we require our average profit. And again, since the cash flow does not change, our total net cash flow was 400,000 for the 4 years. Then we need to subtract our initial investment of 325,000. And this is the average profit. So we need to divide it equally among the 4 years. So that's divided by 4, which results in our new average profit to have the value of 18,750. Now the average investment is just the initial outlay divided by 2. And in this case, our initial outlay is 325,000 divided by 2, which results in the average investment to have the value of 162,500. Now we can easily figure out our accounting rate of return. That is just the average profit of 18,750 divided by the average investment of 162,500 times 100%, which results in the value of 11.54%. Now let's compare it with the previous accounting rate of return. Okay, previously our value was 16.67, but now it's 11.54, which means that our accounting rate of return has declined. And that is not a good thing because we prefer a higher accounting rate of return. So our accounting rate of return has declined. Okay, then the next thing that we can figure out will be the net present value. And in order to figure out the net present value, only our initial outlay has changed, and the remaining net present value for the years 1, 2, 3, and 4 is going to remain constant. So in order to figure out this total value, we just need to change this amount to 325,000 and keep the other values constant. So that's 54,540, 82,600, 97,630, and 75,130. So let's figure out our net present value. We only need to change our initial investment, so that's negative 325,000. And the other values of the present value for the years 1, 2, 3, and 4 is going to remain constant. So that's 54,540 for year 1, 82,600 for year 2, 97,630 for year 3, and 75,130 for year 4. Now this gives our net present value to be negative 325,000 plus 54,540 plus 82,600 plus 97,630 plus 75,130, which results in the negative value of 15,100. So previously we had a positive net present value of 9,900, whereas now our net present value is negative. That is also not a good thing. So let's write it down. Net present value has changed to a negative value. Okay, and the question asked us to explain the impact of this increase in the import duty on the decision. And the decision that we made in B was to advise whether or not Z Limited should purchase the machine to manufacture the new product. And previously our financial factors preferred with our investment, right? But in this case, we can see that the cost of machine has increased, which is not a good thing. Payback period has also increased, which is again not a good thing. Our accounting rate of return has also increased, which is again not a good thing. And our net present value has a negative amount, which means that our decision is now heavily impacted. And we favor with Z Limited not purchasing the machine, and mainly due to the negative net present value, because if there is a negative net present value, it just means that our outflow is greater than the inflow, and we do not need to invest in the investments where our return is lower than our expenses. So let's write it down clearly. The increase in import duty will affect the decision meaning that Z Limited should not purchase the machine to manufacture the new product. And this is mainly because of our negative net present value. So mainly due to negative net present value. Alright, this concludes the last part as well as this entire question of 2023 Specimen Paper 4, question number 2. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.